Hey everybody, it's Pete. Welcome to today's episode of Stocks for Breakfast. So happy you're joining me today. Today we're going to talk about an interesting topic, and it's kind of a follow-up to our private coaching call last night, which is really about putting yourself in a consistent position to win. And it's also about the fact that all charts are not the same. So in other words, all stocks above a key moving average are not tradable. all stocks that hit new highs are not necessarily easy trades just because they're hitting new highs. Most of them are trades you absolutely should be in when they're making new highs. But the question is when. When can you put the trade on, and when should you be having conviction in the trade because it's the right time to get into a trade? We're seeing a lot of new people coming into the boot camp, people coming into our trading room who first of all, thank you. Thank you so much for entering the room and making the investment in yourself. If you'd like to find out about the boot camp or our trading room, definitely click down below. There's two different links you can take a look at. I'd love to have you in the community. It's such a really a tiny investment for you to make in your future. But the point that I want to make is we tend to read stuff in books, and we're like, well, if it's above a 20-period moving average, that means you should buy it. Well, what if the moving average is flat as a board? What if the stock is in the trading range for the last 2 months? We're seeing this where taking the trade setups literally without putting them in the context of whether or not it's a good idea is a mistake. So in other words, a stock might have had a large green candle yesterday, just for argument's sake. But that large green candle happens within the price range where the stock hasn't been able to get out of since January. And I'm saying this now in July. It's not relevant if that's the right price. So where something happens matters to when you get in, and where also includes volume. So in other words, we have a candlestick that's called fuel. Fuel is called where it's a large bodied candlestick with large volume, also breaking out of a trading range. So there's three pieces to that. It's not just a large candlestick. It's a large green candlestick out of a trading range with large volume. Then we have the opposite of that. So fuel starts a move. And then there's the opposite of that, which we call exhaustion. So assume that you have this stock that's trending higher, and then let's say the last three candlesticks are these large green candlesticks, and then the third one has a large green candle, closes on the high, and has a massive spike in volume. So it's the same exact candlestick as fuel, but that candlestick is happening after a sustained order flow. So let's say that's over 3 months, and it's also after 3 momentum candlesticks to the upside, and it has a large spike in volume. So they're both the one, and they happen in different spots. So those kind of things oh, by the way, exhaustion reverses momentum, or at the very least, it's a signal from the smart money that you should be moving up your trailing stop and exiting the position, or excuse me, not exiting, moving up your trailing stop to protect your profits because something has changed. So the point that I want to make is, if you want to take your trading seriously, which I'm sure you do, you're watching this video, you need to put in context where something happens. So in other words, we're going to take a look at a couple of stocks that are very popular in the market, and especially with people who are actively trading right now. And I can understand that. They're flying to the upside. Some of them are doubling or tripling in price within a week. Absolutely can understand that you want to be involved. But if a stock just went up 100% in 3 days, 100%, and you buy on the 4th day, what do you believe are the odds of making profits in exchange for taking risk? They're small. They're small. Unless the story is just so astronomical that the stock is just going to keep going with abandon, which doesn't happen that often, and it's not really what's happening in some of these stocks, you're going to be the last person who bought. So I want to take a look at a couple of examples, and I've been using these examples a lot recently, where I want to say these are absolutely trading opportunities if you make fast decisions, if you have discipline, if you can act quickly if a trade happens to be moving against you. One of the fastest ways that we help people within the first couple of days of somebody joining the boot camp or coming into the room is we first help them recognize poor ideas in the first place. So you start making money immediately just by staying away from bad ideas. But then the second part of that equation is getting into the right stocks at the right time. And I know that sounds like a cliche, but a lot of what I talk about during the day in the room, which is in real time, I say anticipate your entries, anticipate your exits, anticipate if taking risk is the right thing to do right now, and should it be a bigger amount of risk if the idea is a really good idea. So we're going to look at a couple of trades, and again, it's because I don't know many people personally who are watching or who are subscribed to the channel, which, by the way, if you find these videos helpful, please click down and subscribe. That would mean everything to me. It's hard for me to say everybody should be trading the same stock. So I always have to say, if you're fast, if you can make good decisions, these are good opportunities. But here's the key. Part of making those good decisions is if these fast stocks that move and double turn around, you can't act like a victim. You can't say, oh my gosh, I'm stuck in the trade now, I have to hope it comes back. Don't do that. Put yourself in position to be in charge of whether or not you make money, which means if a trade that you like starts moving against you, especially at an unacceptable speed against you and an unacceptable dollar amount, scale out of the position, get out of the position. You can always get back in. Don't be afraid of losing your position in some of these stocks that have doubled overnight, because if it's a real move, they're going to continue to move. So some of them recovered that we've seen recently, some of them haven't. We talked about NIO yesterday, NIO, and we'll take a look at the chart. Some of these stocks are not giving us a second entry because they basically came all the way back down to the excitement price. And that's, quite frankly, some of them are trading like penny stocks, which is not easy to do. If you watch what I do, I like to trade and put you in a position where we're making the easier trade, the trade with the higher probability, the trade where we can clearly manage risk. And if we accept that risk, there's a good chance over time that we're going to make money. So we're going to look at a few stocks and I'm going to give you examples. And again, I want to make it clear. I'm not saying don't trade these stocks. I'm saying don't trade them if you're not good at making fast decisions. I'm saying don't trade them if you tend to get stuck in positions that move against you and then you hope and pray for the market to come back. So we're going to take a look at a couple of them. First, we're going to start out with one that is one that we've been trading with consistency, both as a day trade and a swing trade, and then we'll compare the situations to some of the other ones. Okay. Okay, so SE is a stock that you can clearly see it started out as a $36 stock here in March, when you can see it was actually up in the 50s prior to the pandemic. But you can see the stock is very orderly, has plenty of intraday volume, and really when the order flow is obvious like this, it's easy to manage your risk because the quality of the idea is good. And this is something that's a big idea as well. Trades tend to work out when you pick better trades. And I know that sounds obvious, but it's not so obvious to everybody. And I'm going to show you what I mean by this. So you can see how clear that stock. Now we're going to take a look at this opportunity here. Obviously, a lot of people were talking about bidding the airline stocks during the pandemic and looking for them to hold them, right? The problem is those of you that did not bid down here, and I'm not saying whether that was right or wrong, started buying up here after the stock went from 9 to 23. Almost a 200% gain in 3 days. What I'm saying to you is, what are the odds of you buying a stock after a 200% gain in 2 days? What are the odds? Well, not very good. And this is what you end up getting. Okay? I want to get into another one where we constantly talk about order flow. We constantly talk about how much capital was committed to the idea. Boeing is a very good stock to trade when it's obvious. Right now, it's not obvious. We got clobbered after the pandemic started. We had a rally here where a lot of people bottom fished, which good for you if you did. But then where is the edge here? If you're choosing to fight, if you're choosing to put your money in harm's way, where is the edge? Then we had maybe a week and a half of buying and then nothing again. And now we're in nothing again. So what I'm trying to do is I'm trying to train your eye to say, if I look to the left, how much money was spent by the smart money to help me with this idea? And right now, there was 5 days here. If we go back to the other trade, there was 2 days. That's it. 2 days of buying versus months of buying for easier trades. And again, I keep going back to this stock because it's just one that's screaming and obvious, right? Another one, NEO, which we just mentioned. Okay, this one's a little bit more sustained. So it's actually bouncing and pausing and bouncing and pausing. So it's actually holding up a little better, where it's a little bit more orderly. Okay, we actually said yesterday we like it as long as it stays over 10. But then you take a look at something like this, where again, you should be able to see like that in an instant, where it's only 3 days of buying. That's it. 3 days of buying, where the stock went from 14 to 32 and 34, actually, almost 34. So it more than doubled in 2 days. What are the odds of you buying after a stock that has more than doubled and the stock continuing? Now, the stock actually at this particular point is giving us a spot to manage risk. So if you remember what I talked about at the beginning of the video, I said you could tackle these stocks as long as you can make fast decisions. And number two, it gives you a spot to manage risk. This is a much better spot to manage risk around the $20 area than here, because where is your risk up here? Your risk is almost all the way back down here where it started, and you almost got that, right? Another one, Workhorse is another one that we've been discussing. And again, nothing wrong with trading the stock. And this one's actually a little bit more sustained. So you can see here, this is a little bit more, you have almost two weeks worth of price action here, where smart money was buying over 2 weeks versus 2 days. So can you start to see where you put the pieces together? Your job is to look to the left, because really we're not moving the market. We're hopping on the order flow that the smart money is creating with the market. So if you just instantly look to the left and say, if the smart money is buying this stock, how long have they been buying the stock? And if it's 2 days, your conviction level should be a little bit lower, which is going to require you to make faster decisions because they haven't really started pushing the stock around. If it's 2 weeks or 2 months, that changes the story a little bit. That means that the smart money in that stock has made a commitment to that stock. And it's our job to hop on that commitment. It's our responsibility as traders to hop on that commitment and stick with it until we see it change, which I've talked about recently. A change essentially means either exhaustion, like I described at the beginning of the video, or what we call distribution, like we called out in DKNG a few weeks ago, where there was massive spike in volume over the period of a week, but the price didn't advance. And that usually means the stock is going to start moving in the opposite direction, which it did. There was a news story that came out that the insiders sold $565 million worth of stock, and the stock is continuing to go down. So my point is, there's so much easier trading out there if you dig a little deeper and try to find the opportunities that the smart money is allocated to, and then we just hop on board. Those faster moving stocks, these explosive moves, 100% you can get involved with if you're an active trader who really has a plan and is quick at making decisions. If not, you might just want to step aside and pick some of these easier fights. If you have any questions, absolutely leave me a comment below the video. Please give us a thumbs up and subscribe if you find these videos helpful, which I really hope they do, because my number one goal is to share with you my 20 years of experience as a trader, because trading can be challenging. And if you really want to take this a step deeper and you want to trade with me in real time, click down and learn about the bootcamp or the trading room. I'd love to see you in the community. Have a great day, everybody.